you're drowning in credit card debt, and you're a homeowner. Let me show you real quick a simple way based on appreciation, no matter what the rates are, that you possibly could take a look at saving with your monthly cash flow. So, little longer of a process, but walk with me as we kind of go through these numbers. So we've got a lot of assumptions. I'm going to assume your current home value is $450,000. And let's say you purchased it in the last 3 to 5 years. So you've been the beneficiary of appreciation, so the home value's gone up, but also your current loan amount gives you a lot of flexibility. So let's say you owe $200,000 on this property. So immediately you have $150,000 in equity. Now I'm going to make some other assumptions, right? So let's assume this is at a 3.5% rate. Principal and interest, your monthly payment just on principal and interest, no taxes and insurance, I'm going to assume is around $1,000. Okay? So what I'm kind of calculating here is that maybe you've been into this loan for about 5 years. Let's assume you've also got some other debts, right? We've got an auto loan, credit card, credit card, credit card. Right now, we're in a situation where a lot of Americans are really using this credit card debt in order to really survive month to month. So if we take a look and say on the auto loan, let's say you still owe $20,000. Auto loans right now are averaging around 7%. So that would give you a monthly payment of around $500 a month. And let's say you've got $10,000, $10,000, and $10,000. Let's make the math easy for me, okay? So you've got $30,000 in credit card debt. This is the staggering number, and most people don't know this. The average interest rate on a credit card right now is a little over 20%. And the bigger problem is that $30,000 in credit card debt, 20% interest, your minimum payment per month is probably going to be around $500. The bigger issue with that is that does not pay down any of these debts. So you'll pay $500, $500, $500, $500. This $30,000 will still be there. So everyone is in love with this. We love our 3.5% rate. Don't make fun of my lopsided heart, by the way. That was pretty bad. But you've got some really good appreciation, okay? So I've got $20,000 and $30,000. So in here, I've got about $50,000 in additional debt. And if I owe $200 on my mortgage, now I know that there's going to be costs and fees, but just for these numbers, right? If you did a new loan at $250,000, that would take care of, yes, your 3.5%, but more importantly, these two payments in total, right? So what you're paying minimally, $1,000, $500, and $500, again, I made the math really easy for me, is $2,000 a month, okay? If we were to take this $250,000 on a new loan, today's rate, give or take, right? Let's say it's 7.25% on a 30-year mortgage. This would give you a principal and interest payment of a little over $1,700 a month. So keep in mind, that is just principal and interest. It does not include any of your taxes and insurance. Same with this $1,000 over here. So what we're really looking at is $1,705 versus $2,000. It's a savings of $300 a month. That's $3,600 a year. So if you think of it, two things happen, and maybe even more than that. We consolidate 1, 2, 3, 4, 5 different payments into one. Simplifies your life there. We also eliminate $30,000 in credit card debt. Eliminating that credit card debt based on what the maximums are is going to have a significant increase in your credit score. Your revolving debt ratio is going to go to 0 if we're able to pay off all of these. And so that's going to be a boost to your credit score. You're going to be able to eliminate a lot of these unknowns, simplify your life, and get to a point that now this payment, remember going back to this one only pays interest? This is principal and interest. So it's actually going to be paying the debt down and saving you per month. So before you kind of throw your hands up against the idea of, well, I'm not going to touch my first mortgage rate that I love, I think we need to stop worrying about what the rate is and start looking at what our payments are and how does that hurt us on a monthly basis that a potential quick refinance could actually put you in a financially better situation today with the benefits of improving your credit, still seeing appreciation in your home. You might be setting yourself up in a better financial position than you think by giving up that lower rate for a much lower monthly payment.